You are looking at the cover sheet of a trust instrument signed in 1934, sitting on a reading table at the Rockefeller Archive Center in Sleepy Hollow, New York. The paper is foolscap. The ink is the dark blue of a fountain pen pressed hard at the downstrokes. At the top of the page, in capital letters typed on a 1930s royal, are 6 words. The 1934 Trust. John D. Rockefeller Jr., grantor. Below that, the names of 6 children, each of whom would later become a senator, a banker, a vice president, a governor, a philanthropist. Below that, the name of the trustee, Chase National Bank. Below that, a single sentence I read 4 times before I believed what it said. The corpus of this trust shall not vest in any beneficiary during the lifetime of the youngest grandchild of the grantor living at the date of execution. In plain English, that one sentence is the reason no Rockefeller has paid a federal estate tax on the bulk of the family fortune in roughly 90 years. What I am about to show you is history. It is not tax advice. Speak to a qualified estate attorney and a CPA before applying any of it to your own life. In 1916, when the federal estate tax was first signed into law by President Woodrow Wilson on September 8th, the Rockefeller legal team had already been working on the answer for 2 years. The Revenue Act of 1916 was a war measure. Customs duties had collapsed because of the conflict in Europe, and the United States Treasury needed money. Congress, led by Ways and Means, Chair Claude Kitchen of North Carolina, decided to tax the debt. Estates over $50,000 would owe 1% at the bottom rung and 10% at the top on assets above $5 million. To a small farmer in Iowa, that tax did not exist. To John Davison Rockefeller Sr., sitting in his stone study at Pocantico Hills, looking out over the Hudson Valley at 60 rooms of furniture his lawyers had already moved into legal entities, that tax was the first cannon shot of a war that would last 100 years. He answered it the way he had answered the Sherman Antitrust Act. He answered it the way he had answered the breakup of Standard Oil in 1911. He answered it with paper. The antagonist in this story is not a man. It is not a particular Treasury Secretary or a particular IRS commissioner. The antagonist is a system. The federal estate tax, the gift tax that came in 1924 to plug the holes in the estate tax, the generation skipping transfer tax that came in 1976 and was rewritten in 1986. A century of legislation aimed at one thing: stopping wealth from moving from grandfather to grandchild. Without a toll booth in the middle, the system was built. The toll booth was built. And then a small, polite, very expensive group of attorneys in Lower Manhattan, working out of offices in the Equitable Building at 120 Broadway, built the road that went around it. I spent 3 months reading every publicly available estate filing in the Rockefeller Archive at Sleepy Hollow, New York. By the second week, I had stopped being surprised. By the third week, I had stopped being impressed. By the fourth week, I was angry, not at the family. The family did what any family with good lawyers and the money to pay them would do. I was angry at the gap between what is legal and what is taught. The gap between what a private library at Pocantico Hills knows and what a kitchen table in Akron, Ohio does not. You will see the gap in a moment. First, I want to show you the document on the desk. The structure is called a dynasty trust. The legal name is more precise. It is an irrevocable, multi-generational, generation-skipping trust, drafted to use the lifetime exemption of the grantor for both the federal gift tax and, after 1986, the generation-skipping transfer tax. The relevant code section today is Internal Revenue Code, Section 2601, which imposes the generation-skipping transfer tax. Section 2613 defines who counts as a skip person, generally a grandchild or someone 2 generations younger than the grantor. Section 2641 sets the rate. Section 2642 governs how $1 of exemption gets allocated across the assets in the trust. The structure became radically more powerful on October 23, 1986, the day President Reagan signed the Tax Reform Act of 1986, which gave each grantor a lifetime generation-skipping exemption, a number that was $3 million then and has been adjusted by Congress ever since. But the structure that John D. Rockefeller Jr. signed in 1934 predates all of that. His trust was grandfathered. It was created before September 25th, 1985, which is the line that Congress drew in 1986. Any trust irrevocably set up before that date is, in the language of the tax code, exempt from the generation-skipping transfer tax that came later. The 1934 trust holds the bulk of the family fortune. The 1952 trust, which John Jr. set up for his grandchildren, layered another generation underneath it. Both trusts were administered by Chase Bank. Both were drafted to mature on the death of the youngest grandchild living at the time of signing. That meant the corpus, the principal, would not vest in any single human being for as long as one specific grandchild kept breathing. As long as the principal did not vest, the IRS could not tax it as part of any single dead person's estate. Now compare that to what you have. You have a savings account at a regional bank. You have a house in your personal name. You have a 401k or an IRA. When you die, every one of those assets shows up on IRS Form 706, the federal estate tax return. If your total estate is below the current federal exemption, you owe nothing federally. If you live in a state with its own estate tax, Oregon, Washington, Massachusetts, New York, several others, your heirs may still owe at the state level on much smaller estates. Your house goes through probate. Your savings account is reported. Your IRA pays income tax to the heir over a 10-year withdrawal window. Every dollar is visible. Every dollar is named. Every dollar is taxed. The Rockefeller structure is the inversion of that. The asset is not in your name. It is held inside an entity, often a limited liability company or a family limited partnership. The entity is owned by a trust. The trust was settled by a grantor who is already dead. The grantor cannot be taxed because he is no longer a person under the law. The beneficiaries cannot be taxed because they do not own the asset. They only have a beneficial interest in the income, and only when the trustee decides to distribute it. The trustee is a bank. The bank has been doing this since 1934. Walk the mechanism with me. Step 1. The grantor takes a piece of property, let us say 1,000 shares of Standard Oil of New Jersey at $25 a share, $25,000 in 1934 money, and signs an irrevocable trust deed. Irrevocable, in plain English, means signed and cannot be undone. The grantor can never get those shares back. He gives them up forever. Step 2. The trust deed names a corporate trustee, in this case Chase National Bank. The trustee has what lawyers call a fiduciary duty. That means the trustee is legally required to act in the interest of the beneficiaries, not the bank, not the grantor. Step 3. The deed names the beneficiaries, but in a particular way. The income goes to the children during their lives. The principal goes to the grandchildren or great-grandchildren on a schedule the deed specifies. The principal skips a generation. That is the generation skipping structure. Step 4. The deed names a perpetuities clause. Under the common law rule against perpetuities, a trust could not last forever. It had to vest within 21 years after the death of a life in being at the creation of the trust. The Rockefeller lawyers used the youngest grandchild as the measuring life that bought them roughly 100 years. The legal framing rests on case law that is real and on the books. In 1940, the Supreme Court decided Helvering versus Hallock, 309 U.S. 106. The court ruled on 3 trusts created in 1917, 1919, and 1925, and held that if the grantor retains any reversionary interest, any way the property could come back to him, the value of the remainder gets pulled into his gross estate at death. That was the IRS winning. The Rockefeller lawyers read that ruling the day it came down and rewrote every trust in the family to remove every reversionary interest. No string back to the grantor. No way the property could ever revert. Then, in 1968, the Ninth Circuit decided Crummey versus Commissioner, 397 F. 2nd 82. The court held that if a beneficiary has the immediate right to withdraw a gift to a trust, even for 30 days, even if they never actually withdraw it, the gift qualifies for the annual gift tax exclusion. That ruling created what every estate attorney today calls a Crummey power. And Crummey powers are how families fund irrevocable life insurance trusts and dynasty trusts year after year, dollar after dollar, without triggering the lifetime gift tax exemption. The catch is real. Irrevocable means irrevocable. Once the grantor signs, the asset is gone. He cannot use it. He cannot borrow against it personally. He cannot vote the shares the way he used to. The trustee votes them. The trustee decides distributions. If the family chooses badly, the trustee can become a hostile force the heirs cannot fire. Setting up a properly drafted dynasty trust in $2,026 costs somewhere between $3,000 and $15,000 in legal fees, sometimes much more, plus ongoing trustee fees that compound for the life of the trust. The structure does not make sense for an estate under roughly $500,000 in assets, because the legal and administrative cost eats the benefit. None of this works without a qualified estate attorney drafting it for your state. New York rules are different from Florida rules. Delaware, South Dakota, Nevada, and Alaska have specifically written perpetuity statutes that allow dynasty trusts to last functionally forever. Most other states still cap the term. Here is the historical case that proves the structure works. John D. Rockefeller Sr. died on May 23, 1937, at his home in Ormond Beach, Florida. He was 97 years old. The IRS valuation of his estate at death was $26,410,800. $837. $26 million. Read it again. By the year of his death, the United States press estimated his real wealth, including the value of the trusts he had already created, at roughly $1.5 billion in 1937 money. The estate that the IRS could tax was less than 2% of what the family actually controlled. How did that happen? It happened on paper, year after year, beginning around 1913. In 1913, on May 14th, Governor William Sulzer of New York signed the charter of the Rockefeller Foundation. John D. Rockefeller Sr. endowed it with $100 million over the following years. The Rockefeller Foundation is a charitable foundation, and contributions to it generated income tax deductions during his life and reduced the value of his taxable estate at death. A second wave of transfers, beginning around 1917, moved Standard Oil stock into trusts for the benefit of his children. John D. Rockefeller Jr. received the bulk of those transfers. By the late 1920s, Jr. personally held more than half of what had been Sr.'s stock holdings. Then Jr., sitting in Pocantico Hills, watching the Great Depression eat the country, signed the 1934 trust. That is the trust on the desk. The IRS in 1937 had a choice. They could try to argue that the 1934 trust was a sham, or that Sr. had retained too much control, or that the transfers in 1917 and 1924 were transfers in contemplation of death and therefore taxable. They tried some of those arguments. They lost most of them. The Helvering versus Hallock principle had been written into law in 1940, 3 years after Sr. died. And the family's lawyers had already removed every reversionary string the court would later look for. The final settlement on Sr.'s estate paid the federal government on $26 million. The remaining wealth sitting inside the foundation and the 1934 trust and the network of family limited partnerships was untouched. The principle of the 1934 trust has now passed through 3 generations of Rockefellers without paying a single dollar of federal estate tax on the bulk of it. Because under the law, no single Rockefeller has owned it. What it means now is this: the structure is not a loophole, it is the law. The Internal Revenue Code, the Revenue Act of 1916, the Gift Tax of 1924, the Tax Reform Act of 1986, and the 2017 Tax Cuts and Jobs Act all coexist with dynasty trusts that were grandfathered before September 25th, 1985. Newer dynasty trusts drafted today in states like South Dakota and Delaware can still function for 100 years or longer. The mechanism is legal. The mechanism is open. Nobody made it a secret. Nobody taught it to ordinary people. What regular people do instead is open a savings account. You open one, or your father did. If your grandfather opened a savings account at First National Bank of Cleveland on January 3rd, 1965, and deposited $250 from his railroad paycheck, that money sat in a passbook account paying 3.25% interest. He paid federal income tax on the interest every year. When he died, the balance went through probate. The lawyer who handled the probate charged the estate 4%. The remaining money was distributed to your father, who deposited it in his own savings account and paid income tax on the interest he earned. until he died, at which point a second probate took another 3 or 4%, and what was left came down to you. 3 generations, 3 taxable events, 3 sets of legal fees, and the bank, the First National Bank of Cleveland, kept earning a spread between what they paid your family in interest and what they charged borrowers for mortgages. Most financial advisors will not tell you any of this because they earn commissions on products that depend on you not knowing. The product is your patience. The product is your ignorance of the structure. That is not a moral failure on your part. Nobody taught you. The high school civics curriculum in 1965 did not include Internal Revenue Code Section 2613. The kitchen table in Akron, Ohio, did not have a copy of Crummey versus Commissioner sitting on it. The Rockefeller Library at Pocantico Hills did. So what does this mean for you right now, in 2026? I am not your attorney. I am not your CPA. What I am going to tell you next is what the structures are, not what you should do with them. There are several structures that ordinary people can access today and that an honest estate attorney will draft for a reasonable fee. The first is a revocable living trust. Revocable means you can change it. It avoids probate, keeps your affairs private, and costs roughly $1,500 to $3,000 to draft properly in most states. The second is a family limited liability company, often called a family LLC, used to hold real estate or a small business and pass operational control across generations. The third is an irrevocable life insurance trust, an ILIT, which owns a life insurance policy outside your estate. So the death benefit is not taxed as part of your estate when you die. The fourth, for larger estates, is a spousal lifetime access trust, SLAT, which lets one spouse fund a trust for the benefit of the other and the children. The fifth, and this is the one that mirrors the Rockefeller structure most closely, is a dynasty trust drafted in a state with a long or unlimited perpetuities period. South Dakota, Delaware, Nevada, Alaska, or Tennessee. The threshold matters. A dynasty trust does not make sense under roughly $500,000 in assets because the setup cost and the trustee fees will eat the benefit. A revocable living trust makes sense for almost any homeowner over 50. An ILIT makes sense if you carry a life insurance policy large enough that the death benefit would push your estate over the state-level exemption. A family LLC makes sense if you own real estate you intend to keep in the family. Ask your attorney by name. Walk in and say, I want to discuss a revocable living trust for my home, an irrevocable life insurance trust for my policy, and whether a dynasty trust drafted under South Dakota law makes sense for my situation. If your attorney does not know what you are talking about, you have the wrong attorney. The cost is real but manageable. $3,000 to $15,000 in legal fees for the full package. The Rockefeller family in 1923, when Jr. was reorganizing the holdings he had received from Sr., spent the equivalent of more than $200,000 in today's money on legal work. They considered it the best money they ever spent. 5 generations later, their grandchildren are still living off it. So bring it home with me. The document on the desk at Sleepy Hollow is not magic. It is paper. It is a signature in fountain pen. It is a clause about the youngest grandchild living at the date of execution. The Rockefellers did not invent secret physics. They paid attention. They hired the best lawyers in Lower Manhattan in 1934, and they read every Supreme Court ruling on estate tax between 1916 and 1986, the week it came down. The structure they built is the same structure available, in modified form, to anyone in America with $500,000 in assets and an attorney who knows the code section by number. The reason you did not know is not because the law hid it. The law printed it in volume after volume in the Internal Revenue Code, in the Federal Register, in the Code of Federal Regulations, Title 26, Part 26. The reason you did not know is because nobody walked you through it. I just did. If this changed how you see the conversation, write in the comments, "I want the next attorney meeting." Just that phrase, nothing else. I read everyone. In the next video, I am opening the 1903 Vanderbilt real estate filing from the Newport, Rhode Island Registry. The filing that explains how a single beach mansion stayed in the family for 4 generations without ever being sold, taxed at full market value, or named in a will. Same library, different desk, different document, same lesson. The wealth is not hidden. The instructions are.